Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we'll explore how strategic management can address real business challenges by using the Whittaker Strategy Grid. This approach helps organizations analyze their position and make informed decisions to improve performance and achieve their goals. We'll look at practical examples to understand how this framework works in different situations and how it can guide effective planning and problem solving. Let's dive in and see how strategy development can drive success. Whittaker Strategy Grid is a practical tool designed to help teams move from uncertainty to clear decisions. It does this by organizing 4 key areas: strategic position, strategic options, strategic risks, and strategic implementation into one simple view. This approach, created by David A.C. Whittaker, provides a consistent framework for leadership teams to identify problems clearly, evaluate different options using shared criteria, and commit to action with specific responsibilities, deadlines, and measurable goals. This structure not only helps clarify complex strategic challenges, but also keeps everyone aligned and focused on execution. The grid adds practical value to business by creating clarity and focus up front, requiring a clear statement of the problem and the desired outcomes before jumping into solutions. It ensures that all options are compared using the same criteria like return, fit, speed, and risk, which makes discussions more objective and productive. Risks aren't hidden or overlooked. They have their own space so the team can build mitigation strategies into the plan, rather than trying to fix problems after the fact. Lastly, the execution quadrant embeds accountability by assigning owners, setting milestones, and defining key performance indicators, which helps turn strategies into actionable plans and keeps progress on track. This structured approach makes decision-making clearer and execution more disciplined. Start by clearly defining the problem in terms of value, focusing on specific impacts like cash leakage, growth gaps, or risk exposure. Next, set clear objectives with deadlines and measurable success criteria so everyone knows what you're aiming for and by when. Develop 3 to 5 distinct options for addressing the problem, avoiding small variations to ensure real alternatives are considered. Agree on decision criteria early on, such as financial metrics like net present value or internal rate of return against the weighted average cost of capital, as well as strategic fit, the time it will take to see results, and any brand or regulatory concerns. Identify the data you need to make informed decisions, and if critical information is missing, run a quick data sprint to fill those gaps. Anticipate risks from the start and plan how to mitigate them. When a decision is made, document the reasons behind it. Assign clear ownership, set milestones, and define key performance indicators. Finally, execute the plan and review progress regularly, using what you learn to create a repeatable playbook for future challenges. This step-by-step approach ensures clarity, discipline, and effective action from start to finish. 4 of the chain stores are underperforming and not generating cash. We identified 4 main options: try a turnaround on site, relocate or consolidate stores, change the store format to something like an outlet or click and collect hub, or close the stores altogether. We evaluated these options using criteria like the store's unit economics, how flexible the lease terms are, the appeal of the store's local catchment area, its role in an omni-channel strategy, how quickly changes would show results, and the net present value of potential outcomes. We also considered risks such as potential damage to the brand, financial penalties for breaking leases, risk that customers might not migrate smoothly to new formats, and potential staff turnover. To mitigate these, we planned proactive communications, negotiated leases or sought sublets, ran trial hubs to test sales migration, and redeployed staff where possible. The implementation plan combined different approaches. 2 stores pivoted their formats while also pursuing turnaround strategies. 1 store relocated and 1 closed. Progress will be tracked over 12 months using weekly KPIs like EBITDA, cash flow, sales migration, online sales uplift, and customer net promoter score. Tools such as break-even and scenario analysis and site-level SWOT reviews helped inform decisions throughout. This approach shows how the strategy grid links logical decision-making with clear, actionable execution. Whittaker Strategy Grid helps us clearly understand where we stand and what actions we can take. Currently, 4 of the 40 stores in this national retail chain are losing money or not contributing cash, with negative store-level EBITDA. We see that lease terms vary across these locations, which gives us some flexibility to consider options like relocating or consolidating. Each store's catchment area differs in terms of foot traffic, spending behavior, competition, and their role in omni-channel retail, like click and collect services. While some stores struggle financially, a few still have brand value worth preserving. The main strategic options for these stores include implementing a turnaround by adjusting the assortment, reducing space, optimizing pricing and promotions, renegotiating rent, and boosting local marketing. Alternatively, we can relocate or consolidate stores to lower rent, higher traffic sites or merge service areas, or pivot the store format to outlets, dark stores, or click and collect hubs to support e-commerce growth. If necessary, we can also dispose of or close stores in an orderly way, managing leases and staff redeployment carefully. There are risks to consider, including potential brand damage from closures or format changes, unforeseen lease penalties or repair costs, lower than expected customer migration to other store formats or online, and possible staff turnover that would impact local knowledge. To manage these risks and implement the strategy, the plan includes turning around 2 stores with a format pivot, relocating 1 store within its catchment, and orderly closing another store. This grid gives us a structured way to make decisions based on the current position, available options, risks, and clear next steps. Here we see a listed tech company holding £300 million in surplus cash beyond its immediate operational needs, placing it in a strong strategic position with options to accelerate research and development, particularly in AI, or pursue inorganic growth through acquisitions, joint ventures, or minority stakes. There's also the possibility of returning value to shareholders via share buybacks or dividends while reducing debt, or setting aside funds as strategic reserves. When making decisions, it's crucial to weigh the internal rate of return against the weighted average cost of capital. Consider impacts on earnings per share, strategic fit, risks linked to integration, effects on liquidity and credit ratings, as well as tax and regulatory consequences. To manage risks, strategies like earn-outs or staged payments can prevent overpaying in acquisitions, and staged buybacks with price bands can avoid buying shares at peak prices. It's also important to protect core technology investments by ring-fencing R&D and maintain clear communication with shareholders to avoid backlash. An example implementation could include a £120 million staged share buyback over 12 to 18 months, £90 million dedicated to R&D, £70 million kept as dry powder for opportunities, and £20 million held in liquid instruments. This would be supported by board approvals, market disclosures, stage gates, and tracked through KPIs like return on invested capital, EPS, annual recurring revenue, total shareholder return, and net cash position. This approach is complemented by analytical tools such as NPV and IRR calculations, real options analysis for R&D timing, M&A scorecards with integration heat maps, and portfolio models like BCG or GE, ensuring the capital allocation process stays transparent, disciplined, and auditable. Here we see a clear framework for a stock exchange listed tech company with £300 million surplus cash beyond its short-term needs. The grid organizes the strategic position, showing that the company has excess cash and a strong foundation in R&D and market opportunities. It lays out 4 key strategic options: organic investment focused on areas like R&D and AI platforms, inorganic approaches such as bolt-on mergers, acquisitions and minority stakes, balance sheet optimizations like dividends, buybacks, and debt reduction, and holding reserves for future opportunities. Alongside these options, the grid also highlights the risks involved, including paying too much in acquisitions, timing share buybacks poorly, underinvesting in core technology, and the potential for shareholder backlash. Finally, the grid proposes specific implementation actions, such as staging a £120 million buyback over 12 to 18 months, allocating £90 million to R&D, reserving £70 million as dry powder for acquisitions, and setting aside £20 million in liquid investments. This structured approach ensures clear strategic focus and balanced risk management, while aligning resources to drive long-term growth. When looking at expansion into Brazil and India for consumer goods, it's important to recognize both the growth opportunities and the complexities involved. Both markets have high growth potential, but come with very different retail landscapes and regulatory challenges, along with currency fluctuations that can impact profitability. There are several ways to enter these markets, including using distributors, joint ventures, greenfield subsidiaries, or acquiring local brands. Choosing the right approach depends on factors like how fast the category is growing, how feasible the sales route is, the complexity of local regulations, how much the brand needs to be adapted for local tastes, and restrictions on currency repatriation. Risks such as expanding too quickly, relying too much on partners, positioning mistakes, and volatility in currency or regulations need to be carefully managed. This can be done through phased rollouts, strong partner contracts, market testing, and financial hedges, or borrowing locally. An example implementation plan might start with a distributor model in key Indian states, followed by a joint venture in Brazil if the partner economics make sense, and potentially establishing a subsidiary in India once performance metrics are met. Supporting tools like Porter's 5 forces for each country and category and scenario planning help enforce sequencing and ensure learning before committing to larger steps. This approach helps balance growth ambition with prudent risk management. We're looking at a consumer goods company, considering expanding into Brazil and India, two high growth but complex markets. The strategic options range from starting with a distributor-led approach, which requires less capital upfront and could lead to a joint venture or subsidiary later, to forming a joint venture directly with a local player, setting up a greenfield subsidiary with phased localization, or acquiring a local brand outright. The main risks include managing the complexity of expansion, dependency on the chosen route to market, potential brand mispositioning, and foreign exchange or regulatory shocks. To address these, the plan is phased. First 12 months focus on launching in priority Indian states via a distributor, while scouting for Brazilian joint venture partners. Then, if the numbers work, move into a Brazilian joint venture between 18 to 36 months, and later consider setting up a subsidiary in India if key performance indicators are met. This approach balances speed and risk while allowing flexibility to adapt as we learn more locally. This approach offers several clear advantages. It combines speed with meaningful depth, providing options that are comparable and readily accountable. It's flexible enough to be applied across different scenarios, supporting ongoing learning and adaptation as new information comes in. On the other hand, there are some challenges and risks to keep in mind. One is the possibility of overcompressing complex data, which can lead to oversimplification. There's also a dependency on the quality of the data used, which means inaccurate inputs can skew results. Another caution is false precision, where numbers may appear exact, but actually mask underlying uncertainty. Finally, without a regular review and update process, there is a risk that execution can drift away from the intended strategy over time. Balancing these factors ensures the approach remains robust and reliable. The Whittaker Strategy Grid is designed to bring clarity and accountability to complex decisions, whether it's optimizing a portfolio, deciding where to allocate capital, or planning international growth. This framework helps teams see the trade-offs clearly, align leadership around key choices, and move faster from analysis to action. When used alongside tools like net present value calculations, scenario planning, and Porter's 5 forces, it provides a consistent, repeatable way to tackle difficult problems and turn them into measurable outcomes. This combination makes it easier to balance speed with depth, while ensuring decisions are grounded in solid analysis and shared understanding. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, Thanks for watching.